Jerome Powell, the chair of the Federal Reserve, has addressed the media and outlined their strategy to mitigate the banking crisis and safeguard the United States. Given the recent collapses of Silicon Valley Bank, Signature Bank, and Silvergate, as well as the struggles faced by Credit Suisse, which was bought out by UBS, and Deutsche Bank, the Fed's approach to preventing a global panic in the banking sector is eagerly anticipated. Jerome Powell, in his recent press conference, shed light on the failures of the banking sector. He discussed how the bank struggled, particularly with regard to unrealized losses and uninsured deposits, citing examples such as Silicon Valley Bank. He acknowledged that the banking crisis had repercussions in the economy, leading to credit tightening and potential negative impacts on businesses and citizens. Powell stated that the Federal Reserve may not need to rely solely on rate hikes to control inflation, as credit tightening could naturally lower inflation by reducing the amount of money banks are handing out, thus slowing the economy. However, he also assured that if credit tightening is minimal and inflation remains high, the Federal Reserve will take action by continuing rate hikes until inflation is brought under control. Powell emphasized that it's still early days and further developments in the banking sector will shape the Federal Reserve's future plan. In recent weeks, there has been significant turmoil in the banking sector in the United States. Several banks, including Silvergate, Signature Bank, and Silicon Valley Bank, have faced severe financial challenges, with depositors attempting to withdraw billions of dollars in just one day. This prompted intervention from the Federal Reserve, FDIC, and U.S. Treasury, who stepped in to provide immediate assistance. Remarkably, in the case of Signature and Silicon Valley Bank, all depositors will be fully compensated, which is an extraordinary measure as typically the FDIC only guarantees up to $250,000, and a significant portion of Silicon Valley Bank's deposits were uninsured. Recently, Jerome Powell, the chairman of the Federal Reserve, addressed the banking crisis in a 45-minute press conference, outlining the actions taken by the Federal Reserve and their plans going forward, starting with the situation at Silicon Valley Bank. Hey, welcome to Stock Market Mate. Today we'll talk about Jerome Powell's revelation on how the banks failed. But before we get into it, do subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right to it. As explained by Jerome Powell, there were several critical factors that led to the downfall of Silicon Valley Bank, or SVB. Firstly, SVB had invested heavily in long-term U.S. Treasury bonds, which became problematic as interest rates rose, causing the value of these bonds to decline. Although holding these bonds until maturity would have been fine, SVB faced significant withdrawals from depositors, forcing them to sell the bonds prematurely to cover the withdrawals. This resulted in substantial losses for SVB, which prompted them to try and raise capital, but this move spooked investors and triggered a bank run. According to Jerome Powell, the main issue was that SVB's management had left the bank exposed to significant interest rate risk without proper hedging. Additionally, SVB had a concentrated group of depositors, primarily consisting of tech businesses and startups. In an environment of rising interest rates, these businesses relied on their deposits in SVB to meet their own liquidity needs. This concentration of depositors further exacerbated the problem. However, despite SVB's failure, thanks to the intervention of the Federal Reserve, depositors were ultimately protected from their losses. In the case of Silicon Valley Bank and Signature Bank, the FDIC intervened and closed them down. However, it's important to note that FDIC deposit insurance typically covers only up to $250,000. In the case of Silicon Valley Bank, where the majority of their clients are businesses that maintain higher deposit amounts, it was revealed that 95% of their deposits were not protected under this insurance scheme. This prompted the Federal Reserve, in coordination with the U.S. Treasury and FDIC, to announce that all depositors of SVB and Signature Bank would be fully compensated in order to prevent a contagion effect, where the collapse of these banks could negatively impact the entire economy. The Federal Reserve is keen on limiting the ripple effects caused by the potential failure of these two banks, as the economy is highly interconnected, with one person's spending being another person's income. Unaddressed bank collapses could quickly lead to widespread problems. However, this has raised concerns about the possibility of similar issues affecting other banks as well, prompting questions about the potential risks in the broader banking sector. This was highlighted by Michael Burry on Twitter, who shared an image revealing that Silicon Valley Bank stood out from other banks in terms of unrealized losses compared to their available cash, and a significant portion of their deposits being uninsured. This made them highly vulnerable to a bank run and a prime candidate for potential failure. While other banks did not exhibit the same profile, SVB's outlier status did not prevent the unfortunate turn of events. As a result, Jerome Powell addressed the situation, and the Federal Reserve is now faced with the question of how to address this issue. Despite the criticism Jerome Powell has faced in recent years, many appreciate his dedication to addressing the current situation. He appears to be genuinely analyzing the mistakes made and implementing necessary policy changes to prevent similar situations from occurring in the future. This proactive approach is commendable, as it shows a commitment to learning from past errors. While Jerome Powell did not have much to say about the Credit Suisse saga, as it is not within his jurisdiction, his efforts to address the banking crisis are being acknowledged positively. Regarding Credit Suisse, the Swiss bank that recently failed and was essentially acquired by UBS for a fraction of its value with the assistance of the Swiss National Bank, the Swiss equivalent of the Federal Reserve, Jerome Powell did not have much to say as it falls outside of his jurisdiction. It is not surprising that he did not comment much, except to suggest that the outcome was likely the best possible given the circumstances. While the banking issues were discussed, they were not the main focus of the press conference. The primary topic was the Federal Reserve's next steps in relation to interest rates, especially considering the current inflation rate of 6% and the Fed fund rates at 4.5% to 4.7%. The decisions made by the Federal Reserve in this regard were revealed during the press conference. During the press conference, it was announced that there would be a 0.25% rate hike by the Federal Reserve, with the acknowledgement that they will continue their efforts to bring inflation back down to 2%. However, one noteworthy point from the press conference was when Jerome Powell mentioned that in the near future, the Federal Reserve may not need to raise rates further to control inflation. This is due to the recent bank crises that have unfolded in the past few weeks, which have impacted the overall economic landscape. Jerome Powell's perspective is that the current cautious approach of banks, due to the outgoing bank crises, will naturally result in a tightening of credit. This tightening of credit will in turn put additional pressure on businesses and individuals, which could potentially lead to a decrease in inflation without the need for further rate hikes. This point was also well explained by Hamish on the latest episode of the Young Investors podcast, shared by the speaker. In summary, the concerns in the banking sector could result in banks lending out less money, which can slow down the economy and potentially lower inflation without the Federal Reserve needing to take any immediate action. Jerome Powell acknowledges that it is still early days and we will have to wait to see how the situation unfolds. In terms of the future, what does he envision as the Federal Reserve's plan moving forward? In essence, Jerome Powell anticipates that credit tightening could naturally lower inflation, leading to the Federal Reserve taking a more passive approach and observing the decline. However, he also assures that if credit tightening is minimal and inflation remains high, the Federal Reserve will intervene by continuing rate hikes until inflation is brought under control and returns to around 2%. Well, that's about it for today's video. Let us know your thoughts in the comment section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!